Association of Financial Advisors of India. Knowledge Series in association with Resurgent India ICICI Bank presents a virtual seminar on financing for MSME exporters. Moderator Mr. K. Gupta, Director, Resurgent India Limited. Mr. K. Gupta is the Director at Resurgent India Limited, specializing in corporate finance and management consultancy for SMEs as well as large corporations, handling substantial financial transactions. He also serves as a task force member for government MOUs and on the grievance committee at Power Finance Corporation. With a 36-year banking background and a tenure as General Manager at Central Bank of India, he holds degrees in economics and bank management. Key speakers: Mr. Gaurang Vaswada, trainer, ex-banker and partner, FEX Fin Associates LLP. Mr. Gaurang Vaswada is an ex-banker with 35 years of experience in international trade, finance, and foreign exchange. He has held various positions during his banking career, including that of Chief Dealer Forex and Head of International Division at erstwhile Bank of Rajasthan and as Branch Head, Compliance Manager and Subject Matter Expert, SME, Trade with ICICI Bank. At present, he is actively involved in training for trade and forex-related subjects in and out of the banks and advising corporates in matters involving FEMA and RBI guidelines. He is also a resource person for the Indian Institute of Banking and Finance, IIBF, and faculty for FEDAI. Mr. Bhavin Joshi, SME, Trade Finance, ICICI Bank. Working with ICICI Bank in Trade Finance Department and having 15 years of experience and currently holding position as Subject Matter Expert, SME, Trade Finance, total experience of 20 years and have done CMA and KEB, working with ICICI for last 3 years.
Good evening, friends. I am your host, K. Gupta. I am a Director of Association for Financial Advisor of India and also Research in India. And we welcome you for this most important webinar for financing for SME exporters, organized with ICICI Bank. This is our 9th webinar under the series with the ICICI Bank and under the series of Association for Financial Advisor. This is our 51 webinar. Beside that, we are also holding webinar under Research in India banners, which we have already done 233 webinars in respect of various fields. On the request of our entrepreneurs, our members of the associations and the banker, ICICI Bank designed this virtual webinar on financing for SME exports. I think the experts at present, we are happy to inform you that more than 1,000 registration with us. So people, our participants, our members, even the bankers are showing their keen interest on the subject of export, for which we are having the eminent speakers, Shri Gaurang Vaswada, who is a trainer, ex-banker, and partner of FEX Fin Associate LLP. We also representative from the ICICI Bank Trade Finance SME, Shri Bhavin Joshi. We are going to discuss all the aspects. So what is SME? And what is the export finance? Why you are talking about the export finance? What are the mode of export finance? Availing export finance from the banks. What type of facility? you require how you can approach the bank to avail the export finance. Other mode of financing, what do you expect the banks, other institutions, whether you're talking with the Exim Bank or getting the credit guarantee from the Export Credit Guarantee Corporation, some people are there to mitigate the risk. How you can mitigate the risk because you are not knowing the buyer. How to mitigate that point we are also going to discuss. We are also going to discuss cost of export finance, a comparative study. These are the aspects what we are talking about. I think which is main interest to our entrepreneurs in 2024-25. The export value of SME expected to increase from 3.95 lakhs crore in 2001 to rupees 12.39 lakhs crores. And when we are talking about the number of the exporters, which was hovering around 53,000, now it is expected that it may touch 1 lakh 73,550 in 2004 2005. Expected share of export, India total export, is 45%, contributing to exports by the SME sector, underscoring their critical role in boosting India economy and strengthening global trade. SME plays very important role. As you talk about the GDP, we are contributing about 30%, and manufacturing output 45% contributions. Government has taken so many steps to simplify the procedures, offering incentives for higher productions, providing preferential treatment for market development funds, simplifying duty drawbacks, rules, displaying products, exporter for free at international exhibitions. There are so many agencies, just like a national small industrial corporations. We are talking about the Exim Bank, we are talking about the ECG. I think all aspects, all agencies are coordinating to have the exports. I will not take much time. So I hand over to expert who is with us in last 8 webinars and excellent feedback. He's ex-banker also and thorough knowledge under the export finance. So I request Sri Gaurang sir, please give your thoughts in respect of point what we are talking about. What the SME? Why the export is necessity? Balance of payment, it is helpful to us. And other things, trade deficit, it will be helpful to us. And for the economic development, I think export play a very important role for that. I will not take much time. I request Shri Gaurang sir, who is expert in the fields. I request you to please take over the session and give your thoughts. In between, we, if any question will be there, so we are going to ask you. Mr. Gaurang sir, please.
Thank you. Thank you, Gupta sir, for the introduction and putting the right perspective on the floor now. I must thank ICICI Bank and AFI and Research in India for this opportunity. Very rightly put up that SME has got a very important role to play in the overall industrialization plus our exports. Uh, Roughly 45-46% of the total exports out of India, what we are targeting is roughly 450 billion or so in 24-25, is to be done by SME. Now, very importantly, the role of SME is more so important because we are a population of 140 crores, well spread out country. We need more and more employment to be generated, and the SME plays a very important role in generating the employment and more so self-employment. So more of self-employment, less people in the queue for employment. That is one aspect which I feel that more and more people coming into the MSME businesses and then maybe contributing to the country for the GDP as well as for the export. So from this, I will just share my presentation and then we go from there, trying to understand what MSME is and then from there what exports is and then what are the nitty-gritties of export finance in the to see how we can raise it, what precautions we can take, and all those aspects. Here I just blow it out. One second. So the screen is visible, sir. So we go
Yes,
from
yes, visible, visible.
we go
Please
from
go
here.
ahead,
So
go ahead.
finance for MSME exporters, we're trying to cover the aspects relating to MSME and Exim finance, credit limits, something about pre and post shipment finance, what is the interest subvention impact, whether and what and how we should do the credit insurance, and some of the other aspects of raising the fund. Now, micro, small, and medium enterprises, as government has declared and maybe the classifications have been given. Plant and machinery equipment investment, not more than 1 crore and annual turnover up to 5 crores is a micro industry. Small industry, the investment is 10 crores and the turnover is 50 crores. And medium industry is the investment in plant machinery is 50 crores and the turnover is 250 crores. Now, with this background, when you start a business or when you are in a medium level, you are going to somewhere fall between small and medium. When you start, it is micro, but gradually you grow to small and small will go to medium. What Exim finance is, that let us first know that what export is. So whenever some goods are being sent out of the country, it will constitute as exports, or even whenever some services are being rendered out of the country, it is constituted as exports. Now, whenever you are doing exports of goods or services, that needs to be, because that's the wealth of the country that is going out of the country, that should be compensated by way of inward remittances in a freely convertible foreign currency or a convertible rupee as such. So now inward remittance is the target area for us because that is contributing to the foreign exchange reserves for us, foreign exchange contribution. Now, sir already said that we need exports. We need exports because the trade gap between export of goods and the import of goods is huge, more than 250 billion negative because of our oil import, because of our arms and ammunition, because of our gold, because of our all developmental activities where we want this to come up. Fortunately, the import-export gap between services is not that big. It is likely positive only, and the pace of growth of service export is far better or more than the growth in the goods sector. To push the exports, to support the exports, to make the short-term working capital finance available to exporters, RBI came up with a new scheme in 1967 for allowing rupee finance to the exporters. And then I very distinctly remember in one of the time, the cash credit rate was around 18% or 19%. That time RBI directive was that export finance should be allowed not more than 12%. So this was the thrust given. Now that time 7% differential was there, and that was under the RBI direction. In 1992, RBI came up with the scheme of allowing foreign currency financing. We call it PCFC now. The banks had a lot of reserves relating to FCNRB funds or EFC funds, escrow funds, etc., and nostro balances. They allowed this to be used for financing of exporters at that time. Now, the basic guidelines of a 2015 circular still are there, but most of the things from RBI side have been left to the banks to decide on the quantum of exports, timeline, etc., the percentages, etc. But still, we keep that in track that what is to be done and how this. But largely, banks will still abide by certain conditions and be guided by certain conditions as given in the 2015 circular. Now, why there was a need to have a separate topic of export finance? Because the financing of exports is totally different than the domestic. Domestic finance is within the country, and once again, sir, the domestic finance is within the country, and The export finance, we are financing for those transactions which are out of the country. So in this manner, it is a different. Now, very particularly financing of foreign bills is there. Pre-shipment and post-shipment is order-based financing. It is not a cash checkbook, or it is not a what you call RTGS based. I don't have rights for RTGS also there. Now, cross-border financing as such is not similar to domestic finance because it is transaction based. Every order I need to go and tell the bank or the institution, I have received an order, I need finance for this, and the tenor may be different for each order. Now, this is a finance allowed to, somebody's mic is open, Rajan sir, can you please check and mute?
I request to please unmute your mic.
So, now finance is allowed for promoting of exports, and that is why there is a government intervention in regulating the interest rates. Or Bhavin sir, your mic is open, I think. If you can please check. Okay, thank you. And this finance can also be allowed to DTA units as well as SEZ units. Now, DTA, SEZ is what? A cordon area, which we call a customs area, but it is a huge land piece. It is not one unit. And DTA is what is not in SEZ. So, SEZ normally, for the customs point of view, it is something which is almost out of bounds. It is out of the country treated as a processing area. Now, the third part is deemed exports. Deemed exports is where somebody is exporting, somebody is selling some goods. The goods are not going out to the country, but yet they have been given the credit of deemed exports because either they are earning foreign exchange or they are saving foreign exchange. We'll see in one of the slides, I've elaborated. Now, only two stages. When I receive an order, I need funds to procure raw material, process it, and pack it. That is one stage. And once the goods are packed, I need to ship it. And after the shipment, I have a bill of lading. So a bill financing requirement is drawn. So necessarily, I would categorize export finance as a pre-shipment finance, a post-shipment finance, and largely pre-shipment finance and post-shipment finance. When we talk, I need a limit set up in the bank. So I must have a limit. Now we'll see how limits are set up. And then we have an additional window in the form of export bill negotiation. And nowadays, factoring all across, maybe several factoring companies have come up in India. Our India-grown companies are also there, which are giving us the window to raise finance against bills drawn on overseas buyers. So as I talk, pre-shipment and post-shipment relates to credit limits. So let us see how credit limits are set. Now, when you talk of credit limit setting, banks would adopt any of the methods, MPBF, turnover, or operating cycle. Now, I had several times thought that I may not talk of the methods of banking, but one major aspect why I bring it here is that when in MPBF method or operating cycle is there, you are more or less nearer to what is the requirement of an exporter. When you talk of turnover method, our exporter may not have a uniform cycle for each of his product or uniform cycle for each of his order. Some order may be 60 days DA, some order will be a 120 days DA, some order may be 180 days DA. So if I apply this 20% turnover method, then the unit may not be given proper finance which is required. So other than turnover method, whenever an exporter has to draw, he needs to talk to the bank and say, either apply MPBF or processing operating cycle. Now, in the operating cycle also, there could be certain commodities where there is a seasonal requirement or agri-produce where I need to stock in first 4 months and then sell for all 12 months. So my requirement in the first 4 months may be very high, and then maybe taper down till the next crop or next production is done. So peak and non-peak limits can be set up in the export finance also. Why I have put it here, but it is not only the domestic, only you have a peak, non-peak. In export also, we may have a peak, non-peak. Now, going forward, bank may ask for security. So our prime security is whatever goods we are procuring from the finance taker from the bank. But to have a stake of the exporter or the entrepreneur, particularly bank, because it is not the bank's funds that the big bank is giving. It is somebody else's fund, the depositor's money, largely. So bank would need something of your seriousness to be known. And when the seriousness is required to be known, then bank asks for collateral security. It could be in the form of house property, it could be office residence, deposits, mutual funds, bonds, policies, etc., etc. Anything could be there. And in additional, we can have a security in the form of credit insurance, that is the ECGC cover. Either bank itself has taken or exporter may be asked to take very specifically on certain buyers or certain countries. Personal or third party guarantees, that is always there, because for a large corporates also we need at times personal guarantees to be given. Now, if I do not have a security, and largely this is something which has been brought down by entrepreneurs, that bank don't give finance on the basis of security, then we have a central government scheme which is called as CGTF, Central Government Credit Guarantee Fund for Micro and Small Enterprise. Now, this is largely for manufacturing sector, also for services, but largely for manufacturing sector. And the limit here is 5 crores now. Earlier it was 2 crores. What the system is, the bank would set up a limit, register your unit and the limit into the CGTMSC portal, give certain forms, and every month that guarantee fee is required to be given, ranging from 0.75 to 1.80%, and your limit is secured by the guarantee of the government. So the bank does not have the physical security, property, bonds, etc., but bank has a security of a government guarantee. Now, this is also applicable for the export funding. So in one of the workshops yesterday only somebody said, sir, our bank says this is not applicable for exports. No, CGTPC limits are also applicable for exports, and banks may have their own criteria of maybe judging the unit or the balance sheet or the business, but this is also available for export. Now, last year they also allowed hybrid lending. So hybrid lending means I already have a limit for 1 crore in a bank where I have given certain security, but now I want enhancement, but I am not able to give any security. So additional 1 crore or additional up to 5 crores can go up to in the CGT MSC, while 1 crore will remain with the bank, and the security will cover both first charge, second charge concept is there in this method. Now, let us see some of the conditions in the export finance when the limits are sanctioned. Now, when an umbrella limit is there, you could have a sub-limit for pre-shipment and another limit for post-shipment. Now, pre-shipment is something where the money is given in the hands of the exporter. So, if the total limit is say 1 crore, bank may give in the hands of exporter maybe 60 lakhs or 70 lakhs or 75 lakhs. But the remaining limit may be under post-shipment, where evidence of shipment is also already there. The bill of lading, the shipping bill is already there. So, that can be taken up to 1. The security is defined the margin of the requirement, a stake of the holder, a stake of the exporter. So maybe for pre-shipment, it could be 20%, for post-shipment, it could be 10%. Now, pre-shipment, ideally, the freight and insurance is not financed. On the post-shipment side, only the profit is not financed. So the margin is less in post-shipment, more in pre-shipment. Uh, Bank may also specify the buyer-wise limit, which we call credit concentration limit. I normally say all eggs not in one basket. So I would suggest exporters don't export all your goods to one buyer. Try to spread out across couple of countries and across couple of buyers, because all your business in one buyer. Maybe we saw some of the exporters who were doing business only in Russia, and that couple of months were of a crisis. We saw some exporters who were only doing business in Sri Lanka, where the couple of months they were not getting money. So better not to put all your eggs. So maybe that will put your business into standstill for a couple of months, and that is not good for any business purpose. And if you are dealing, or if you have a sister concern or an associate concern in an overseas market, then banks may also put a certain limit on that, because that is also what giving money in one hand and going to another hand via media system. Then country-wise exposure. Now, country risk ratings are there. You will see that. So, based on the country risk rating, banks may say, sir, for maybe D grade countries or declassified countries, we will not finance. And C1 and C2, we will finance only up to 50%, and rest all you can do in good countries. So, good countries versus bad countries, certain limits could be there. Or bank may also specify that in certain countries, you will have to take ECGC buyer-wise policy compulsorily. And ECGC cover, either the bank has taken a whole turnover curve, which we call export credit insurance for banks. Now, certain banks, the private sector banks are not there, but certain old public sector banks and old private sector banks have this ECIP, and rest all depend on the post-shipment side on the individual policy. So this is all on the limit side in brief. Now we see that what export finance is a two-level finance. One is on the pre-shipment. Pre-shipment is what? Up to the shipment. Now, what is it? For purchase of raw material, processing, manufacturing, etc. Up to the shipment. Now, up to the shipment means freight and insurance is not covered. If it is a service industry, then working capital required. Post-shipment means finance given after the shipment until it is realized. So once you have a bill of lading in hand, shipping bill in hand, it is a bill financing. Let us move to some of the aspects related to pre-shipment. As we saw that pre-shipment is for procurement, processing, etc. It could be fund-based as well as non-fund-based. Fund-based is giving money to in your hands. Either the bank debits your packing credit account, gives the credit to your current account, or maybe at your request pays to your supplier. That is fund-based. Your interest meter starts now. On the other hand, non-fund-based is issuing an LC in favor of your supplier of raw material. What is it? Your interest is deferred for say 90 days period. So you are first issuing a LC from your bank in favor of your supplier, where he says that I will be glad to take the money after 90 days if you open an LC. And on the 90th day when the bill is due, bank will create one loan account by way of fund-based facility and pay off that LC liability. So what you are doing, you are paying commission for 90 days. After 90 days, you are paying the interest on your loan. Now, the tenure is usually based dependent on the business and business cycle. What type of business you are doing? So somebody is manufacturing something which is having a 90-day cycle. Another fellow is manufacturing something which may need more cycles, so maybe 120 or 180 days. Some merchant trader is there who is only procuring the goods from the market, packing it, or only labeling it and then exporting. He may need only 30 days of business cycle. So it will all depend. I cannot claim that I should only have 180 days like that. Now, once the limiter said, I am not given a checkbook. I am not given RTGS rights. I don't have a separate account control on that. So how do I draw the money? So every time I get an order or a letter of credit for exports, I need to go to the bank and explain to them or maybe submit an application. And against that order, bank will calculate the DP, drawing power, and allow you the funds in your current account or maybe to your supplier, etc. As to be decided by the bank. Every time when you go to a bank, why this is required? Now, each order may have a different shipping period. Shipment to be done by 31st of January. Next will be can be done by 31st of March. The third order will have a shipment to be done by 15th of January. For all these drawings, there could be a different due date to be calculated. Due date is what? Last date of shipment plus 21 days. That is the due date calculation. So when I calculate the packing credit due date, that different notional accounts are opened for each of the drawing, and the due date is one cutoff point up to which I can get my subvention, concessional interest rate, and my account is regular. Post which it becomes an irregular account or an overdue account. If I get a large order, I may take money in one go, or I can take money piecemeal. So it can be released in parts also against one order. Now, this is very typical for packing credit that it is allowed only on the FOB value of the order. So if I have a CIF order, I have to first come to FOB value. In normal circumstances, 12.5% is the percentage which is deducted from CIF to FOB. So I get against $100, I get my value of 87.5. And say, as per the example, if my margin is 20%, so 87.5 minus 70.5, I will get $70 or $70 equivalent of the fund. So that is how it is calculated. The period of advance we have discussed now, the maximum period is 360 days as per the rules. Now, this 360 days, everybody will not require. But on an exceptional, my order is maybe postponed. The buyer says you don't ship now, or I am unable to ship because of container issue, because of the quality issue, because I'm not able to get the exact raw material, strike at port, strike at factory, etc., etc. Or even sometimes buyer says you defer the shipment. The goods are not picking up. It's a back-to-back shipment. He says, "ये महीने का shipment 2 महीने बाद भेज." Then what does? So it is extended up to 360 days, but this is the last. 360 days beyond that, if advance is there, it comes out of that portfolio of export advance. We will see how it is. The liquidation of advance is to be submitted. So we said pre-shipment should be converted into post-shipment. So by submission of bill, the bill can be purchased, discounted, or negotiated. Or if it is not shipped, then maybe if I get some other advance, some other advance against some other order or maybe a collection bill, etc., I can always use these funds to adjust my pre-ship. But what if 360 in 360 days I am not able to ship the goods or I have not received any further advance, etc.? Then, if it is not adjusted in 360 days, then this ceases to qualify export credit right from day one. Ab initio. From day one, this advance will be treated as domestic advance in default. Now, ideally, whatever subvention or interest equalization benefit I have received for 180 days or 360 days, that needs to be recovered from the exporter and paid back to the government. So, the impact I will tell you by way of example. One of the exporters had a limit where it said 6.5% repo rate plus 3% of markup, so 9.5% was the interest rate, out of which he was getting 3% because of MSME subvention. So net rate is 6.5%. If it was not paid on 360 days, the bank had a criteria that this will be treated as domestic advance, where the CC rate was 11.5%, and there was a penalty of 4% and 2% overdue charge. So what happens? 6% over 11.5% is 17.5%. So against 6.5%, I am required to pay back to the bank 17.5% for 1 year for that entire. This is one aspect. Another is that I brought a remark in your credit files. One export finance was not paid even in 360 days. The exporter has failed to meet his commitment. So that needs to be watched out. Please watch that your advances don't get overdue. If they get overdue, then get it adjusted within the earliest period from any of the export proceeds or any bill payment, etc. Don't if you fail to watch it, we may fall under such of the traps. For those established exporters who have good track record or units in SCZ, DPZ, RBI has also allowed a facility of availing of packing credit without submission of order or LC. But the condition is that this order or LC must be submitted within a reasonable period, maximum 30 days, and all banks are following this 30 days. Adjustment here is done on FIFO basis, not on the basis of the exact due date, because at the time of availment, the order is not submitted. Now we talk of sub-suppliers. Now sub-suppliers are those suppliers who are manufacturing the goods or manufacturing the raw material, which is helping the exporter to do export. The exporter is the party who has got the export order. So sub-supplier and the export holder can then share the finance between them by way of an Indian inland LC route or a disclaimer for the export order holder. And what is it? The benefit of the concessional finance can thus be passed on to my supplier. So maybe I am a merchant exporter. I am buying a pen or maybe or you can say stationery or notebooks or diaries, which I am putting on my own label and selling it abroad. Now the actual work is being done by some supplier. So why not keep him with me in my own bank? I would suggest the same bank is more beneficial, and then get him the benefit of the concessional finance. So if he is getting a subvention or if he gets the concessional finance maybe at a lower rate, definitely my pricing will also slightly go down. Deemed exports. We talked in the second slide about deemed exports. The goods do not leave the country, but the payment is received in Indian rupees or a free foreign exchange. Now, free foreign exchange payment is where I think I supply goods to a SEZ or UU or EHTPs or under the projects funded by multilateral agencies, or maybe some thermal plant is going on where some boilers or generators are being supplied by BHEL, money is going to come from World Bank, that would be covered here. Or somebody who has got an import license. If I have an import license, I will spend foreign exchange or I will remit foreign exchange and get my imports. But I have another company which is ready to supply me locally. So against advance license, instead of importing, I am paying in rupees, but still the guy is helping us to save foreign exchange. So that is also covered here. Projects notified by ministry or goods funded by UN agency. Now in foreign currency and rupee financing, only one major differential is there. One major differential is that our benchmark rate is different. In rupee finance, we have got repo rate or T-bill rate, as SBI also does at times at T-bill rates. But in foreign currency financing, our rate is not the domestic benchmark, but our alternate reference rate, which is SOFR, secured overnight funding rate. Is a secured overnight funding rate is for each currency, it is different. So where I have a repo rate of 6.5%, I may have a SOFR of 4.5, 4.6% as of now for next 3 months period in dollars. In PCFC, I can avail foreign currency in one currency. Maybe the order is in dollar, I can avail euro. Also, the period here is 360 days maximum. Now, in certain commodities, my requirement of packing rate is more, like in cashew nuts or HPS groundnut or de-oiled cake exports, etc., where the value of exports invoice I can take in foreign currency, whereas the surplus I will have to take in rupees. The disbursement of the foreign currency funding can be done either in rupees by converting the dollars, or it can be remitted for my import requirement directly from my loan account. So either in dollars or in domestic rupee. But since this is a loan, this cannot be credited to EFC account. The liquidation is same way by way of purchase discount negotiation of a bill. One more aspect is there when we borrow funds in dollars. Bank is taking an additional risk by way of giving us foreign currency, and in case the exporter fails to generate foreign currency within a reasonable period after due date, then what happens? Bank cannot indefinitely period continue the risk on that. So there is a concept of crystallization or delinking of rate. So 30th day from due date, if the bill is not paid, then the foreign exchange risk is crystallized by way of notional selling of dollars to the exporter, and then your rupee loan can continue in rupees for a further period of 60 days. Otherwise, it will become NPA if it is crosses 90 days. So we have just completed the pre-shipment aspects. I'll just start and maybe we will look into what post-shipment is. Post-shipment is what bill finance. Now, post-shipment is loan advance granted after shipment of goods. So after submission of documents. Now, what documents will I have to prove to the bank that goods have been shipped? I will raise an invoice. I will have a bill of lading or ARV bill. I will have a shipping bill in this. Three important documents. There are all other documents, certificate of origin, packing list, inspection certificate, maybe legalized certificate, fumigation, etc. So when I give the documents to the bank, the goods on which I had taken pre-shipment are not in India. So my prime security is already sold. So I need to take a post-shipment and adjust pre-shipment. So this is self-liquidating in nature. This also can be availed in rupee or in foreign currency based on the benchmark used, repo rate or alternate reference rate. Now, here also that margin requirement will be there. So I said that margin could be 10% here because banks do not fund the profit of the exporter in this case. And what do they purchase discount? They will purchase discount the invoice or the bill of exchange. So application of exchange rate is there at the time. And the interest rate from the date of purchase till the notional due date is recovered upfront. Bills can be purchased if they are side bills. Bills can be discounted if they are usance bills, or if the bills are under LC, then we call it negotiation. It could be with recourse or without. Now, if the negotiation of bills under LC is done within your sanctioned limits, then it is a with recourse fine. But if it is done outside your sanctioned limits, under the lines given to the LC issuing bank, then it is a without recourse fine. So we'll have to see whether the bank is utilizing the limits or not utilizing. Now, recourse means bank can always come back and recover the money from you. If it is without recourse, bank has no right to come back and ask for the money with you. It is already dependent upon the LC issuing bank in this case. So that is the case. Now, this is something very typical for the post-shipment finance. Calculation of transit period or cash calculation of the notional due date. For all side bills drawn in foreign currency, 25 days normal transit period is calculated for the documents to reach the other part of the country, the world, and maybe the other bank presenting the documents for payment, etc. 25 sacrosanct. FEDA Rule 2 says very specific. And if it is rupee bill drawn abroad, then 20 days. Now, in case of LC bills, where reimbursement is there under the clause, then 5 days are allowed. But when it comes to usance bill, I have two types of usance. One where I say 90 days usance. Now, the intention of the exporter is to allow 90 days to the buyer from the date he accepts the bill of exchange. So for acceptance of bill of exchange, I will add 25 days here. So I allow 115 days here. The maximum is 365 days from the date of shipment. And if it is a fixed due date, 90 days from shipment date, 90 days from bill of exchange date, then it is an identifiable date I have got. So I calculate 90 days from that given date and then residual number of days. So two types for usage and various different tenor given for side. As I said, that application of forex rate is there because my bill of exchange is drawn on 90 days. 90 days for $10,000. Bank will buy dollars from me. Bank will buy the bill from me and give me the rupee or dollars at that stage. Now, if the bill is not paid on due date and subsequently also it is not paid, delayed, then what happens? So bank on the 30th day from the due date or master due date will again crystallize the bill, dealing with the forex risk, notionally sell the dollars to the exporter and liquidate the forex liability, whereas the rupee liability will continue for further. One aspect I would come back to crystallization and say that whenever bank is selling dollars to you or buying dollars from the exporter, every time there is a component of margin. When the bank buys the dollar, bank will charge you a margin, say 20 paisa margin. When the bank is crystallizing, again, then they are selling the dollars to you, then it is again 20 paisa margin. And after a couple of days or 1 month, when you get the bill payment, now it is a clean, the risk is yours. Bank will again buy dollars from you and again 20 paisa margin. So what happens that if crystallization happens, we as an exporter, I tend to give thrice the margin to the bank, which is impacting my total cost. That needs to be taken care of. I must always follow up with the buyer to pay the bill in time. If it is not on the due date, at least 5-10 days here or there, but not beyond 30 days. Post shipment in foreign currency, again, the benchmark is linked to SOFR and not to rupee rate. So only this is the difference here. Let us come to interest subvention subsidy. Now, from time to time to promote exports and to reduce the overall cost of export.
One minute.
Yes, sir. Yes, sir. Yes, sir.
For a pre-shipment, what is running account facility?
Yes, sir.
Being provided to the exporters. Have any view on that? Running account facility.
Sorry, sir.
For pre-shipment, what is running account facilities? There is one account. There is no question of anything. So what you are talking about, first in, first out. What is the position in running account for packing patterns?
Running account, sir, the order is submitted subsequent to the availing of the advance. From time to time, it is not a one-time drawing. So again, here that FIFO method is applied here. But wherever the order-based financing is there that order-based liquidation is exists. So here FIFO is applied. Whenever the inward remittance is received for the exporter, that goes to address the pre-shipment finance on running account.
Okay. Another point for a LC, what is red clause under the LC? How it is beneficial for the exporters?
So when an exporter gets an order, but he does not have funds to start the maybe procure the raw material or procure the funds, and the buyer otherwise is reluctant to give the advance, so he can get the LC structured in such a manner that he facilitates the advance through the LC advising bank or a nominated bank in India. So LC itself has a clause where it says that upon the exporter coming to you or to the nominated bank in India, the finance of maybe say 25%, 30% can be allowed to him even before submission of the documents, merely on the basis of declaration. And that is a red clause. So the risk of giving an advance is built in the LC itself by the LC issuing bank, and which is facilitated through the nominated bank in India.
Very important. This is an important aspect which we want to bring the notice of our participant. Another point is what you are talking about, the turnover. If you turnover, we're talking about the 50 crore rupees plant and machinery, that to a depreciated value,
Yes.
and 250 crore is a turnover. What is the position of the export turnover? That is included in that.
Yes, sir. Overall, total turnover.
This is total
The
turnover.
definition says total turnover.
Total turnover. And export turnover is also included in
Yes,
that.
it is also in.
Go ahead with that,
So,
please.
thank you, sir. So let us now talk about interest subsidy, or we call it interest subvention in the current regime. Government from time to time has been allowing interest benefits. They are putting the concessional interest rate to the exporters by way of subsidizing the exporter. Now, this was sometime back 5% and 3%, and then in the last regime, when the this September 21 post that, it was valid till March 23, where it was announced as 3% for MSME exporters and non-MSME exporters and merchant exports under that 410 tariff line, 2%. Now, in the foreign trade policy itself, or when announcing this, to control, because this is ultimately the government funds which are being given to the exporters, to control the overall system, they have made it mandatory for the exporters to register on a DGFT side on an annual basis, one time every year, every financial year registration is required. If the exporter has got more than one bank, then he has to generate two UIN numbers, giving the details of the limit, the name of the bank, the AD code, etc. And then that UIN is required to be submitted or returned to the bank every time I draw from that bank. Now, until March, when this scheme was extended beyond March 24 to June 24, the cap of 10 crores per IC was put in. And there was also a rider that if any bank is allowing export finance at 4% above repo rate, that is maybe in the current scenario 10.5% plus, then they were barred from drawing this. So it necessarily made that banks should not allow export finance above 10.5%. So that was the upper cap, maybe silently given by the government and RBI. Now, when it was extended beyond June, it is extended now till December 24, where non-MSME exporters have been taken out of this beneficial area, and only up to June they were allowed to be availing this benefit. Now, for MSME exporters, this has been extended up to December. Maybe we are expecting on Monday, Tuesday, the extension may again come back, and with a rider of 3%. Now, one more cap has been announced till March 25. 50 lakhs of total subvention per IC. What does it mean? If I have already availed more than 50 lakhs before June, then I disqualify for the rest of the period, because this was announced in September, so maybe rest of the half year. If it is 50 lakhs, then what will be impact? So 50 lakhs is equivalent to 3%. Maybe my total cost is 9%, so the total interest could be 50 lakhs into 3, or approximately 1.5 crores. And if 1.5 crores is the interest for 1 year, then the total limits are there. So largely more of the MSMEs are covered here, smaller ones. Maybe the 250 crores may not come in the medium ones, but the smaller ones are all covering. And now, even the yesterday's meeting with the finance minister, I understand that there has been a push by all the trade bodies to increase this value also, the percentage also, bring it for merchant exporters also, because large portion of our exports are also done by merchant exporters. So even they need to be subsidized on that. So we talked about limits, we talked about pre-shipment, post-shipment, but what about our credit insurance? So government has got an organization called Export Credit Guarantee Corporation of India, where it gives the credit guarantee to exporters for supporting exporters. Why I need a credit guarantee? Because the demand in the overseas market is such that I don't get advance in all cases. I don't get side bills in all cases. I don't get LCs in all. I am required to give credit to my buyer, and that is required to be covered because I don't know that buyer. I have never seen that buyer. I have never visited that country. This is available for goods and services, and there are separate policies available to the financing banks as well as exporters, because banks are also giving credit, so they are also giving an additional security by way of ECC cover, which we call ECI. Now, for banks, there are two policies which we call pre-shipment credit and post-shipment credit policy. ECIB, Export Credit Insurance for Bank, their entire turnover of the finance based on the what you call the product basis, it is covered under the area. For pre-shipment, the premium is recovered from the exporter. For post-shipment, it is borne by the bank themselves. For the exporters, there could be a turnover-based buyer policy, specific cover policy, etc. ECGC also announced country risk ratings in 7 gradings: A1, A2, B1, B2, C1, C2, and D. So we will see separately what countries are there and how they are categorized. Policies are exporters' standard policies are largely on the turnover base. So somebody is expecting 20 crores of export turnover, he will take a policy of 20 crores. So entire turnover covered, my premium is very less. Then I can also take policies for one export, one country, multiple exports in a country, multiple buyers in a country, etc. Now, in a standard policy, all commercial and political risks are covered largely up to 90%. And in of the very small exporter, I think some 5 lakhs rupees shipment, etc., 95% cover is also there. Why so? ECGC covers are all risk sharing. Even in the bank policy, at times the banks are getting 65% to 75% of the cover. In case of MSME, it is 85% cover, but 15% loss is required to be borne by the bank themselves. Now, what this does not cover? It does not cover the dispute with the buyer. It does not cover the import license related issues. So, exporter exported out of India, the buyer could not arrange the import license, and because of that, the goods were destroyed. ECG will not pay. So, whenever I am exporting, and if the buying buyer country has a requirement of an import license, before making shipment, I should ensure as an exporter that the buyer has got the license there to import that commodity, and I should get a copy of that for my satisfaction. Otherwise, ECGC may not pay my claim. Now, insolvency of agent or a bank, exchange loss, because exchange is something which is maybe day in and day out fluctuating, so that is not covered. And general insurance clauses, the marine insurance clauses, fire, theft, burglary, etc., are not covered. I can have a specific policy, exposure policy on single buyer, exposure policy on multiple buyer, consignment policy, specific shipment policy, services policy, construction policy. It has got also overseas exposure policy. All those policies are there. The ECGC would give a policy to you, then they will give you the credit report on the buyer. They will set limits on the buyers, and the process is there that every month I have to declare under a turnover policy. One last line which I just wanted to, which I have marked in red. Wherever the exporter is not a SEZ unit or a status holder, they are required to dispatch the original documents to the buyer or buyer's bank through the Indian banking system, AD. And if this is violated, if a DTA unit who is not a status holder dispatches the original documents directly to the buyer, not through the banker, then, and in case of any eventuality that it does not get the money, even if you have a policy, your claim will not be entertained until this transaction is regularized by the bank or RBI. And such cases are very difficult to come to get approval from RBI or the bank and then get it done, and it delays the entire process of claiming. These are the seven gradings. The last update of October 24 I have taken. A1 is insignificant list: Russia, USA, Spain, Australia, very least low premium for your buyers there. Then low risk is UAE, Thailand, Saudi Arabia, Philippines. Uruguay was in B1 earlier. It has been brought to A2. B1 is moderately low: Panama, Taiwan, Namibia, Peru, Bhutan. Moderate risk is Jordan, Barbados, Greece. Now, Fiji was in B1, it has been brought down to B2. Bolivia was in C1, it has been brought up to B2. C1 is moderate. Sorry, what I was there? So, okay. C1 is moderately high risk. Maldives, Russia, Iraq, Turkey, and Gabon. Gabon has gone down. High risk is Burundi, Djibouti, Pakistan, Myanmar, Ukraine, and very high risk is Afghanistan, North Korea, Yemen, Zambia, Ethiopia. So Ethiopia was in C1 because of the foreign exchange crisis there, it has been brought down to D. Now, this is one benchmark where the bank will, when they sanction the limit, they may say that for all your buyers in C1, C2, and D, or including B2, you should have a buyer-wise policy. it is safer for us. Obtaining a buyer-wise policy is safer. Why? That 1% premium being paid to the ECGC will turn out to a boon in some odd time. Number one. Number two, when I decide on my basket of exports, I may not decide on all my buyers in Myanmar, Djibouti, Afghanistan, Yemen, Iraq, Turkey, etc. I may have one of my buyers in Russia, one of my buyers in Yemen, one of my buyers in Maldives. But my major exports should be insignificant, low, moderately low, or moderate risk. And there also, wherever it is moderate or moderate high, I must go for a policy on my own instead of my bank asking. So those exporters who are not availing credit limits from the bank, and there's a huge mass for that. Please go and talk to ECGC, maybe get the connect through your bank or directly, and cover your risk because of this geopolitical issues now in the market. Every now and then, maybe I read somewhere that some around 45 tussles are there across the globe. Syria, Yemen, Pakistan, Afghanistan, some bomb was there 2 days back. Now you never know, your exports to Afghanistan are more in risk. Your exports to Pakistan are more at risk. All these things are there. Okay. So we move on now to the last segment, factoring and export bill negotiation. 5 or 10 more minutes and then the presentation by the bank. Now factoring is another mode of financing on the bill side. It is not on the pre-shipment side. An alternate route to avail finance. A factor is an approved method. So there is a factor chain international. All the factoring agencies are member of that, and they do the financing plus other activities also. Maybe the sales ledger follow-up, limit setup, debt collection, absorption of losses by way of credit guarantee, etc. For us, factoring started in '99. I know very well that Canara Bank and SBI factors were two agencies which had come up there at that time. And now, after 2011, when we had this Factoring Regulation Act, many factoring agencies like Trip Capital, India Factors in India grown company, many factoring agencies have come up in India to finance export on the receivable side. So what actually they do the debt administration by way of giving you the limits on the buyers, credit protection by way of giving you the insurance like ECGC. Okay, they take it from global agencies. Now, what they do is they set up a limit. I will come here next slide. I think it is assessment of the exporter, assessment of the importer. Then they will ask you for your 10 top 2 or 3 or 4 clients. Your 4 buyers, they will make an assessment on the importer and then tell you that for A, you have 1 lakh rupees limit, $1 lakh limit for 90 days bills. On B, you have a $2 lakh limit for 120 days limit, and the bill should go through the banking system or directly. Then this will be space-wide. Now, on this, when you submit the bill, the company will pay you 80%, 85%, or even 75% in some cases, or 90% in some cases, and the balance, so that you receive upfront, that eases your cash flow, and the balance is paid after the bill is finally paid by the buyer, after deduction of charges, of course. Financing of exporters bill drawn on importer, and follow-up, recovery, insurance, everything is done by the factory. The only catch here is that since this is a foreign currency financing, your cost is in dollars linked to alternate reference rate, and at times this is more than our rupee finance. But since this is a without recourse, this is without security, people are trying to take this because even if I pay 11% interest in terms of dollar, I may pay it because I'm not getting otherwise the finance from anybody. I don't get subvention, benefit, etc. People are still taking. Now, without limit, I also can avail finance under the LC negotiation window, where the LC is issued by a bank which is acceptable to my bank. It becomes an additional window. No limits required, or even if I have limits over and above limits, I can do it. So, no limits by exporters. Bills are negotiated on the lines of the LC issuing bank. Each bank will typically have, globally larger bank will have some maybe 100 banks or 150 banks where they have smaller or bigger lines in different countries. So all risk is taken on the LC issuing banks. Their documents are normally sent first, acceptance received, and the bank pays. So it takes 5 to 7 days for negotiation. Now this is done like ideally on the SOFR side, the foreign currency funding, but wherever the exporters are getting subvention benefit, banks have now started doing it in rupee side also. This becomes an additional window to raise working capital beyond your limits also or without limits. Now, whenever you get an export LC, what needs to be checked? If I want to take finance under this window, what needs to be checked? That whether that LC issuing bank is acceptable by bank. So whenever you are finalizing an order, at that time itself, you ask your buyer to give the name of the bank through whom they are going to open an LC. Then you go to the bank and tell them, sir, this is the LC, whether the buyer's bank, this LC bank is acceptable to you or not. That is checked before establishment of LC, because if it is not a good bank or not a first class bank, you can ask your buyer to change the bank or get the LC confirmed in India. The next is get a draft LC from the buyer. Now, draft LC, because at times what happens that whatever conditions are there in order or whatever conditions have been discussed verbally, they don't translate into LC. And then when the LC comes, it is difficult to get an amendment, because the amendment again will cost, say, $500 to the buyer. Then who pays this $500? So before issuance of LC, get a draft LC. Understand preparation of error-free documents. Now, this is very important. Even though I have a good connect with the buyer, I am relying on the LC issuing bank. Don't give them a space to get out of the transaction. If you leave any discrepancy or if you are not able to prepare any documents which are error-free, 100% compliant, comma, full stop, spirit, etc., dates, then the bank may get out of the transaction. So you are relying on a bank, the bank is getting out, then you are again now relying on the buyer. So your transaction becomes without LC. Check bank is negotiating the document without recourse. So when you talk to the bank, say that they should do it on the bank lines. This becomes a window for the additional working capital. The issue which is faced here, large part of our exporters are not aware of this benefit, and they don't insist on good bank to open an LC, maybe the bank negotiating the bills without recourse. At times they do not know the preparation of the documents. So we are engaging with corporates for their in-company programs to discuss the costs and cons and the cost, because now discrepancy cost is $100 per discrepancy. The other guy may point out 5 discrepancies and deduct $500 from your account. And error-free documents is must. So learn to have an error-free documents to transact in a good manner under the LC. So this is all from my side for the people audience here. Learning is the beginning of health. So I'll take an example of LC. If you learn to prepare error-free documents, you are saving $100, maybe error charges which the other bank normally charges, and this will give you an insight, in-depth knowledge about that. Thank you all. You can take down my details, maybe get in touch with me subsequently for any of your requirements. Asking anything is no issue. Anytime you can call, send WhatsApp. If I don't pick a call because of any of the pre-assignments, just drop me a WhatsApp. And wishing you on the end, wishing you a very happy New Year and a prosperous New Year. The country needs exports. We need to grow exports. We need to take finances. Any method, but exports need to increase for the country. We have a very steep target of $1,000 billion 2030, and we are roughly at 450 billion now. Run rate required is too high. Thank you all. Thank you very much. Thank you, sir.
Thank you, Gaurang. I think you have covered very nicely what is pre-shipment, post-shipment, how to mitigate the risk by taking the ECG policy. I think you covered very nicely. Any question will be there, we'll come back to you. So now I'm requesting Shri Bhavin Joshi sir, who is SME Trade Finance ICICI Bank. So ICICI Bank also play very important role in export finance. So we should listen from him. So how the ICICI Bank is helpful to our entrepreneurs who is going for to export or who is proposed to have a export. So how ICICI Bank can be helpful to them? So Mr. Joshi, please give your thoughts.
Thank you, Gupta sir, for this opportunity. And good evening, all. I'm Bhavin Joshi from ICICI Bank. And as Mr. Gupta rightly said, our bank has been aggressively marketing the export finance, and all the products which Gaurang sir had just referred to, we have been allowing or we have been sanctioning these kind of export loans. And many of our customers have been availing the benefits of interest equalization scheme also. So we urge the members of the team to have these benefits taken through the bank and have the business develop to the next level. In this session of mine, I would like to inform you guys about the digital proposition through which the bank has developed its products as well as servicing the customers largely in terms of loan disbursements, in terms of expediting the export bills for collection, export bills lodgement activity, as well as having import bill financing done. So would request all of you to just avail the services of ICICI Bank with respect to export finance and import finance through digitally. Yeah. So next slide, if you can just start with the slides. So as all of you know, there has been a large requirement with respect to doing business online, and we as a bank have been instrumental in providing these facilities online to our customers. We have been able to not only do the day-to-day general banking operations through this services, but we have been also able to provide trade services 24 by 7. Next slide, please. Our digital solutions include the Trade Online portal, wherein our bank has provided all sorts of trade transaction services incorporated into it, wherein we are able to issue BGs, LCs, we are able to lodge the bills, regularize the bills. We have been also able to make disbursements against the EPCs and PCFCs. We have a turnaround time of settling inward remittances through this digital platform within an hour's time. This amount gets credited to the exporter's EFC account or current account. We have an ability of having BGs issued in a period less than 3 hours for any FD-backed BG. If at all there are limit-backed BGs with the terms and conditions, we have managed to deliver that also within 3 hours if the limits are set in process. We have been able to do outward remittances within 5 hours, whereby the remittances have been initiated and a swift message is sent across to the overseas beneficiary within 5 hours time frame. With our InstaBiz program, the MSME segment has been able to avail the disbursements of EPCs through mobile app. There has to be a single authorized signatory who can just order for a disbursement and through his mobile app, and the disbursement is done within a 2 hours time. We also have a facility of issuing paperless BG through the help of NESL portal, where digitally signed and stamped BGs are being issued to the various beneficiaries. Currently, there are around 28 odd beneficiaries registered on this portal, to whom we as a bank have been successfully providing BGs digitally. We also have Forex solutions for MSME segment, whereby they can book their Forex rates online and have their currency hedged as well. We have capital account services extended to our customers, through which we guide the team for pre-vetting of the various submissions, what they have to do with respect to verification of FDI filings, etc. We have a flagship trade account called as One Globe Trade Account, which allows all the customers to have flat charges being levied for the various services offered by the bank. Can you go with the next slide, please? Largely, this is a round-the-clock service what our team has offered with respect to export leg. We have inward remittances, export bill regularization. As you know, the RBI has from 2016 onward, there has been a monitoring of importer and exporter activities through IDPMS and EDPMS portals, whereby the we bankers have been helping trade or helping business team to regularize all their export bills. So we have EDPMS portal linked platform or dashboard, which helps the customer to know what all bills have been outstanding and pending for regularization. It helps the customer to real-time update its bills and obtain the EBRCs thereby. We, as informed earlier, the EPCs and PCFCs are getting disbursed online. We also have the lodgement facility of collection bills, and we provide the bank guarantees through Trade Online platform. Similarly, we have the import facilities with respect to issuance of letter of credit, having the import bills regulation done, import payments being conducted within 5 hours time frame, and various other service payments. There is no setup cost for having this digital platform being launched at the customer's end. The transactions are paperless and there's a quick turnaround time. This happens to be the most beneficial product for MSME segment in current times. Next slide, please. This feature has been largely helpful to the customers, whereby they have the pre-filled forms, the payment schedules can be made, they are able to regularize bills at real-time basis. There's a single view dashboard which enables the customer to view all their regulatory pendencies, both on import leg, export leg, and also for all the transactions which they have ordered to the bank, which have been at what stage. There are customized alerts which are being sent in order to know the transactions completion, execution. The customer can also get a virtual guidance in case if the customer gets stuck while applications being made to the bank. We have provided both a chat GPT as well as an online platform through which they can take the guidance from our team. There has been an online deal booking facility for all our customers where they can book FX rate online. Yeah, next slide, please. Well, these are the specific accounts which our bank helps the exporters to open with respect to parking foreign currency funds and deposits therein. It's EFC account, special foreign currency account for the SEZ units, and diamond dollar accounts for the diamond tiers. Next slide, please. As informed earlier, the InstaBiz platform of our mobile app has been helpful to various customers of MSME to digitally apply for EPCs, and they are able to avail instant EPC disbursements, and the export orders can be submitted within 30 days of time frame. They also avail the running account facility through this platform. Yeah, next slide, please. Well, these are various support systems to the MSME segment where we have developed a portal in nexus with various small time vendors who provide the information, who provide the services for developing trade, for international trade business for the MSME segment. We have created a knowledge hub. We have provided an insurance teams for various customers to interact with the insurance agencies. We have provided details of logistic forms, which enables the MSME for transporting, excuse me, for transporting their goods from one place to another. We can also have a verification of various buyers and sellers through the portal of Trade Emerge. They can identify the prospective buyers and sellers as well. And with the help of initial practices, initial activity which needs to be done to start the business can also be provided by this platform. Yeah, next slide, please. That's it from our side. Thank you, Mr. Gupta. This was a presentation
Thank
from
you,
our
Joshi.
side.
Excellent, excellent. You explained very excellently. What is
Thank you,
innovation scheme introduced by the ICICI Bank?
Yeah.
You also given the forex solution to our entrepreneurs. So anybody
Thank you.
interested to have a pre-shipment, post-shipment, non-fund-based limit, bank guarantee, letter of credit, even a term loans, they can approach the ICICI Bank. I think, Joshi sir, you explained very rightly. Thank you very much. Now I am coming back to Mr. Gaurang. Sir,
Thank you,
there
sir.
are some questions from
Sir.
the audience. So please see your screen
Yes, sir.
and give some reply to them.
So the first question says definition of fund-based and non-fund-based.
Yes.
Now, in a fund-based limit, uh, it is the actual money which is drawn by the borrower, and the bank starts interest from that date. So funds are actually given by the bank to the borrower. It is fund-based, and your interest meter starts from that particular time. Non-fund based, the money is not given, but only a credit note is given by way of guarantee or an LC or an SBLC, where bank says that if there is a default or if there is a default in payment or if there is a default in maybe execution of the transaction or if there is a default in maybe performance, etc., bank will be liable up to that amount. There you don't pay the interest, you pay the commission for issuance of guarantee or issuance of LC. Fund based is interest based, non-fund based is not non-interest based facility. Another question is which says, please repeat example for post shipment. Now, the name says post shipment. Post shipment means finance which is allowed by the bank after shipment of goods. Now, how does a bank know that shipment has been made? An exporter will go to the bank, submit the export documents by way of, say, invoice, the commercial invoice, the bill of lading or airway bill, which is evidencing the shipment of goods going out of the country. And in our regulatory system, we have to file a shipping bill. Shipping bill is filed at the customs port or post, etc. That shipping bill copy and maybe plethora of other documents as required by our country or as required by the buyer's country. Those set of documents, when you give and bank will finance that bill, that is a post shipment finance. So post shipment is a bill finance on the side of when the goods have already sailed out of the country. Next question from Mr. Radesh is pre and post shipment can go beyond 365 days. Yes. The maximum tenure for pre shipment is 360 days from the date of advance. Maybe initial period is 180 days. Then I got extended to 270 days, and then again extended to 360 days, maximum 360 days. And on the 360th day, I submit a bill. So bank will finance that 180 days bill to me by way of discounting and adjust the pre-shipment finance. So 360 days was plus 180 days, go to 365 days. Ideally also, if I have a pre-shipment finance which is extended beyond 180 days and I have a bill which is for 180 days, it can always go beyond 365 days. In all scenarios, it will not be there that I can avail for one transaction beyond 365 days because all the orders may not get extended, all the bills may not be beyond 180 days also. Example, 200 days pre-shipment and 200 days post-shipment. Yes, it is possible. 200 days pre-shipment is possible because if you have a business cycle of 200 days or if you have a business cycle of less number of days and then you are extending it, it could always be 200 days. But post-shipment, ideally 200 days will come on the credit, other trade credit side. So ideally it is what 180 days plus an extension. Can a pre-post shipment be under non-fund based credit limit? Yes. Pre-shipment can be under non-fund based, post-shipment ideally not under non-fund based. Pre-shipment can be, there could be a limit of 50 lakhs of pre-shipment within which an LC limit of 20 lakhs can be there. What is the cost of ECGC, which is very high as cost to value of shipment? Sir, insurance cost is insurance. I am buying a car of 10 lakh rupees. I am paying 40,000 rupees of insurance nowadays. The insurance is what? If you are buying an insurance for 50 lakh rupees, maybe 1% or 1.5% depending on the country, depending on your tenure, depending on your type of bill, etc. will depend. It is less than 1% also. It could be if you've taken whole turnover policy of 5 crores of your turnover. Maybe it is 0.5% or 70, 80 basis points also. Is the private insurance of credit risk insurance policy acceptable to banker? Yes. Even some of the private insurance companies which are non-life insurance companies are offering such policies and that should be acceptable to your banker. You have to check with your bank which is financing the trade. Can advance taken be settled from pre-shipment loan and rest can be post-shipment finance? Advance taken from pre-shipment. Sir, advance taken is pre-shipment only. So when you take an advance, it is a pre-shipment. And then that pre-shipment needs to be adjusted from post-shipment loan. I think you wanted to ask that if I take a pre-shipment loan, if you receive some advance from abroad, that should be used to adjust pre-shipment advance, and balance can be done through post-shipment. So if it is not clear, then you may maybe unmute and then ask the question or get in touch with the seller. So I think these 7-8 questions are there. Advance from the party, yes. If you have taken a pre-shipment advance, then advance from the party will be adjusted, should be adjusted there, and balance can be adjusted from post-shipment. So it is clear now. So all questions done, sir. If any
Thank
more
you.
questions,
Thank you very much. I think you have excellently explained. Acha, Gaurang Sahib, one point is, Gaurang Sahib,
Yes.
commercial banks are giving a loan, advance, pre-shipment or post-shipment. Any other agencies or any mode, any entrepreneur can approach them for a pre-shipment or post-shipment.
Sorry, sir, could not get
Any
it.
other agencies are
Agencies.
giving them the pre-shipment and post-shipment beside the commercial
But
bank.
what they are giving is the commercial loans, which does not fall under the RBI guidelines of pre-shipment and post-shipment. But pre-shipment and post-shipment is necessarily given by commercial banks or cooperative banks also, which are authorized dealers banks. Because ultimately, on the post-shipment side, they need to handle the bill, and this bill is handled by the authorized dealers only, so it is restricted to authorized dealers. But the post-shipment side, factoring agencies are there, which are giving post-shipment, but that can all
The
that is also
Exim Bank.
but
I'm
not
talking
under
about the
those
Exim.
subsidy guidelines of pre-shipment.
And what is position of Exim Bank? They are also giving a pre-shipment?
Yes, sir. Exim Bank largely gives pre-shipment and post-shipment on the project export based finance side. So project exports, they give the finance. They also have a window where they are giving line of credit for maybe promotion of exports to third world countries for export of goods out of India. There also there those funding is there, but not directly for the merchandise export under this. But
Very
SIDBI gives, or maybe SIDBI is an 83, all those banks, private sector banks, public sector banks, small private sector banks, which are new on the block, or even some of the big cooperative banks are there, which are 80 banks. They all give the.
very nice. Lastly, if any advice to our participants from your side, being an expert in the banking sector, any advice to them?
Sir, my advice is that know your rights and serve the country.
Very
Because we find many of the people who are availing cash credit and doing export business. Many
Very
of the people who are availing cash credit and doing a business of sub-supply to a large exporter, because many people don't want to get into the documentation aspect or maybe getting connected to the buyer abroad or maybe flying abroad in simple terms. So they supply to merchant exporters here. Now, even if you are supplying to merchant exporters, talk to your bank, how can you avail benefits under the export finance window? Then your LC related awareness should be there. The third and the lastly, the factoring is there. So maybe if you are able to reduce the cost of manufacturing by reducing your overall financial cost, you will be more competitive in the world in supplying the goods, and that way contribute to the country by increasing the exports from it. That is my final subject.
very nice. Mr. Joshi sir,
Yes, sir, tell me.
any advice from your from ICICI Bank
Sir,
to our
as a bank would always advise all the MSME segment customers to be always compliant with respect to the regulatory parameters of RBI. Uh, as a matter of fact, India has been developing on export-import business, and MSME has been at the front end runner for the same. So entrepreneurs from MSME should be aware of all the regulatory guidelines and support bank for having these completed. That's it from my side.
Thank you very much. I am at the end. I am thankful to the ICICI Bank, especially Mr. Joshi and our trainer, Mr. Gaurang, who has explained all the schemes of the ICICI Bank and how the banker are helping these people, either you're talking about the interest subsidy or talking about the pre-shipment, post-shipment, and the mitigation of the risk. I think they have explained very well. I have no word to express our gratitude to our speakers. And moreover, participants asked so many questions. I think they must be satisfied with the reply given to them. If any questions still left, so you can write to us to Research in India or even to the Gaurang sir directly or to Mr. Joshi, let they can explain you. Or I feel that you can avail the services of ICICI Bank for the pre-shipment, post-shipment, even fund-based, even non-fund-based limits. So I am also thankful to the off the screen, our people who are putting their best efforts. Mr. Rajan, Mr. Ankit, Mr. Ayush, and Mr. Devesh, Lokesh, and other team member to whom I could not put the name. So many people work together to see that the maximum people, members, bankers can be benefited for the scheme. So I am also happy that more than 1,000 people get a registration. I think this is the maximum. So we request all the participants who have participated, or even in YouTube, you can listen later on also. So any feedback from your side, please send to us. And ICICI Bank also if possible, so that we can have a further improvement and avail the services from the ICICI Bank. Beside that, we are an association for financial advisor. All financial advisor, more than 400 people are under membership. So you can also opt to membership of the Association for Financial Advisor. Beside that, we at the Research in India level, we are preparing the draft project report. We are also helping the SME sector and other exporters to avail the benefit from the banking sector. If anybody interested for the DPR, even our bank is conducting the techno-economical study for almost all the banks. So any TB report is required, or any valuation report is required, or anything is required, because we are in a multi-phase work under the research and panel, we are doing it. We are thankful to participant also who has a faith in us, who are giving a good feedback and always obliging us in such webinars for that. So lastly, I'm thankful to ICICI Bank and Mr. Gaurang sir, who has explained very clearly how you can get the benefit from the banks in respect of financing and how we can mitigate the risk for that. With this, I close the session and thankful to all the participants also. Thank you very much for it. Thank you.
Before Gupta Sahab, you close this session, a few words from my side. Thanks a lot for leading almost all the webinars of the AFI and the Southern India. I'm sure we get your blessing and guidance in the times to come. And wish you all a very happy and prosperous new years to all the participants. I'm sure your blessing will continue in the year 2025 also. And thanks to ICICI Bank for all the support extended to AFI in 2024. And I'm sure we will get the same support and guidance in 2025. Stay in touch with AFI. I request all the participants for more knowledge sharing platforms.
Thank you,
Thanks a
Raj.
lot, sir.
Thank you,
Thanks a
Raj.
lot, sir. Thanks a lot, sir.
Thank you very much. Okay.